It's 2035, and Europe feels like a magic trick. You start the morning in Paris with a flaky croissant and coffee so good it makes you forgive the price. The streets look polished, the buildings look eternal. And every corner feels like a postcard you've seen 1,000 times, except now you're standing inside it. By lunch, you're already in Rome. Not after a long flight, not after a stressful transfer, just a smooth, near-silent hyperloop ride that turns countries into neighborhoods. You eat under sun-warmed stone, surrounded by ruins that have survived emperors, revolutions, and centuries of human drama. And by evening, you're in Berlin, holding a cold beer by the river. Watching the city glow with the confident calm of a place that has reinvented itself more than once. Everything is fast. Everything is convenient. Everything looks perfect. And then you notice the silence. The sidewalks are spotless, but the downtowns feel oddly hollow, like they're performing city life, rather than living it. The cafes are full, yet the crowd is older than you expected. More gray hair than backpacks. More retirees than students. When you do see younger faces, they're often behind the counter or on bikes, delivering food or cleaning tables. Moving quickly through a life that seems less like a launch pad and more like a treadmill. You decide to buy a souvenir, something small, just to bring home the feeling. A scarf, a magnet, a postcard. The shop looks charming and local, vintage signage, rustic shelves, soft music. But the receipt prints with the name of a holding company you don't recognize, registered somewhere far away. The payment terminal runs through a brand you've seen in airports on 3 different continents. The family-owned story is part of the decor, but the profits don't stay here anymore. At first, it's easy to shrug and call it globalization. Money travels. Companies merge. Tourists like you come and go, and the world gets more connected every year. But once you start paying attention, the pattern stops feeling random. It's not just a few souvenir shops. Entire blocks of prime real estate have been bought up and bundled into portfolios. Landmark hotels are run by foreign funds. Major ports and logistics hubs, places that decide what flows in and out of an economy, are managed under contracts signed elsewhere. In some regions, even parts of the energy system have been effectively outsourced, generation projects financed and controlled from outside. Grid infrastructure operated for profit, strategic assets treated like financial instruments instead of national foundations. The streets still look beautiful. The trains still arrive. The lights still turn on. But the steering wheel is no longer firmly in local hands. For a traveler, that might sound like trivia. Who cares who owns the cafe if the espresso is great? Who cares who holds the deed if the skyline is stunning? But ownership is influence. Ownership is leverage. Ownership shapes what gets built, what gets cut, where investment goes, and who benefits when an economy grows. Ownership is the difference between writing your future and renting it. So what you're really walking through isn't a superpower in the old sense. You're walking through a region that is still wealthy, still safe, still admired, yet increasingly unable to control its own economic destiny. This isn't a story about Europe losing its culture, and it's not a moral fable about virtue or decline. It's a story about incentives and constraints. Europe didn't wake up one morning and choose to fall behind. It drifted there, slowly, predictably, through a chain of policy choices that seemed reasonable in isolation, but damaging in combination. Through structural weaknesses that compounded year after year while the rest of the world sprinted. To understand how sharp the drift has been, rewind to 2008. Back then, the European Union and the United States looked like economic near-twins. Their overall output was comparable. Their living standards were among the highest on Earth. The idea that Europe could become a dependent junior partner, buying technology from abroad, importing growth instead of producing it, would have sounded absurd. Yet fast forward to the present, and the gap between them isn't a rounding error. It's a chasm. One system found ways to turn innovation, capital, and energy into acceleration. The other increasingly specialized in stability, rules, and preservation, until stability became stagnation. The thesis is simple: Europe's slowdown isn't an accident, and it isn't fate. It's the predictable result of choices, of how the continent powers its factories, funds its companies, regulates its markets, supports its families, and defends its borders. 6 deep wounds, mostly self-inflicted, have been draining Europe's strength for years. And if you follow those wounds to their logical conclusion, you get that 2035 trip, breathtaking, seamless, and faintly unsettling, because beneath the beauty, the future is no longer being built here. In 2008, Europe and the United States looked like economic twins separated by an ocean. Their total output was roughly comparable, their middle classes were strong, and their institutions, banks, universities, infrastructure, healthcare systems, were the kind the rest of the world pointed to as models. If you had taken a snapshot back then, you could have reasonably believed the next few decades would be a close race. Different styles, same tier. 2 advanced economies with the talent, capital, and credibility to keep setting the global standard. Then the paths split. Fast forward to today and the contrast is hard to ignore. The American economy looks like it hit the accelerator and kept its foot there, growth compounding. Tech giants scaling into trillion-dollar platforms, capital markets pulling in global money like a magnet. Europe, by comparison, often feels like it's walking uphill with a backpack full of bricks, still moving, still functioning, still stable, but stuck in a slower gear. When you put the numbers side by side, the gap isn't just academic. It's the size of an entire major economy. It's the difference between a system that generates momentum and a system that struggles to regain it once it's lost. And that's what makes this so important. Europe didn't become poor. It became relatively weaker. It became less decisive, less competitive at the margin, less able to turn talent into dominance, savings into investment, and policy into performance. In a world that rewards scale, speed, and technological leverage, Europe increasingly found itself playing defense, protecting what it had rather than building what it needed next. The easy explanation is cultural. People love cultural explanations because they sound deep while staying vague. Maybe Europeans are more relaxed. Maybe Americans work harder. Maybe Europe cares more about quality of life. Maybe the U.S. is more entrepreneurial. But those stories don't really hold up under pressure, because they treat outcomes like personality traits. They imply Europe chose comfort, the way someone chooses a weekend nap. They ignore the reality that incentives shape behavior, and systems shape incentives. What actually happened is more mechanical, and more uncomfortable. Europe's divergence is the result of policy trajectories and structural constraints that compounded over time. Decisions made for good reasons inside one decade created problems in the next. Trade-offs that looked manageable in a stable world became liabilities in an unstable one. And once those liabilities stacked up, even small shocks, an energy shock, a war, a capital reallocation, a technology cycle, hit harder and lasted longer. Think of it like 2 athletes with the same potential. One trains in a system designed to maximize performance, even if it's chaotic and painful. The other trains in a system designed to minimize risk, even if it slows improvement. For a while, they look equal. Then the competition changes. Suddenly performance matters more than safety, speed matters more than caution, and the gap opens fast. In the U.S., the machine that converts ideas into scale is brutally efficient. A startup can launch into a single massive market, raise large rounds quickly, hire aggressively, pay with equity incentives that reward risk. And, if it wins, go public on deep, liquid exchanges with a culture built around growth. When American firms dominate a new platform, cloud computing, social networks, AI infrastructure, the rest of the economy benefits from the spillover. Better jobs, higher returns, more investment, more tax revenue, more optionality. The system is noisy and unequal, but it's built to sprint. Europe, meanwhile, is often built to govern first and grow second. Its markets are fragmented, its regulatory layers multiply across borders. And its political incentives are tilted toward protecting existing stakeholders, especially in aging societies where older voters carry more weight. That doesn't mean regulation is bad. It means regulation has a cost, and costs matter more when your competitors are moving faster. When expansion across the continent feels like navigating 27 different rulebooks. Growth stops being exponential and starts feeling bureaucratic. When capital markets are shallower and risk is punished more than rewarded, companies don't die dramatically, they stall quietly. And stalled companies don't become global champions. They become acquisition targets. Meanwhile, Europe also made itself more vulnerable on fundamentals, energy, demographics, and security. Energy is the hidden input behind everything: industry, logistics, housing, food, and the very price level people live inside. Demographics determine whether your workforce expands or contracts and whether your welfare state gets cheaper or more expensive over time. Security determines whether you can treat defense as an afterthought or whether you suddenly have to pay for guns and butter at the same time. For decades, Europe could assume those fundamentals were handled: energy would stay affordable, trade would stay open. And American security guarantees would keep the neighborhood calm. Those assumptions weren't crazy in the world that existed after the Cold War. But the world changed, and Europe's model didn't change fast enough. So the divergence isn't a mystery and it isn't a morality play. It's the outcome of compounding constraints. A system can be sophisticated and humane and still be strategically brittle. It can provide stability and still lose the ability to generate dynamism. It can remain rich and still drift into dependency, relying on foreign technology, foreign capital, and foreign strategic protection to preserve a lifestyle it struggles to fund on its own trajectory. That's why the 2035 scene feels so eerie. The trains are sleek. The city centers shine. The museums are full. But behind the glass, the machine that creates new wealth, new industries, new platforms, new productivity, is weaker than it should be. And once you accept that, the next question becomes unavoidable: what, exactly, is draining Europe's strength? The answer is not one thing. It's six. 6 structural failures, 6 deep wounds, that have been bleeding Europe's competitiveness for years. And until they're confronted, the gap won't close by itself. It will widen quietly, year after year, until the continent that once defined the modern world becomes something else: a beautiful place to visit, a comfortable place to retire, and a much harder place to build the future. For decades, Germany wasn't just another European economy. It was the engine, an industrial powerhouse built around autos, chemicals, machinery, precision manufacturing, and the dense supply chains that make modern life possible. When Germany was strong, Europe felt strong. Its model after World War II looked almost unbeatable: high-skill labor, world-class engineering, and exports that traveled everywhere. But that model was also quietly dependent on 3 external pillars. First, American security guarantees through NATO, which allowed Germany to prioritize industry and welfare over heavy defense spending. Second, China's massive demand, which became a crucial market for German cars and industrial goods. And third, most important for the factories themselves, cheap Russian gas, which powered energy-hungry sectors like chemicals, steel, and heavy manufacturing. The system worked until it didn't. When the geopolitical relationship with Russia collapsed and Europe's energy landscape flipped, Germany's cost structure changed almost overnight. Industrial competitiveness is fragile. You can have the best workers and the best machines, but if your energy input becomes permanently expensive, profit margins vanish. And once large-scale industry leaves, it rarely comes back. A case study makes the point. BASF, one of the world's biggest chemical companies, isn't a niche brand, it's embedded in daily life, from consumer products to medical supply chains. Its German headquarters in Ludwigshafen is so large it functions like a city inside a city. Yet BASF began making decisions that should have set off alarms across Berlin, cutting and closing major production lines in Germany. Not because the company forgot how to compete, but because the economics stopped working. Chemical production consumes enormous energy. And Germany's power prices surged as cheap gas disappeared and the energy transition was rolled out faster than the grid, storage, and replacement base load could reliably support. Instead of expanding at home, BASF committed massive investment to new production capacity abroad, including a major build-out in China. The irony is brutal. Germany, which prides itself on strict environmental and labor standards, ended up nudging its own industrial champions toward a country willing to keep costs low, even if that means burning more coal and operating under looser constraints. And BASF wasn't alone. When enough firms make the same calculation, it stops being an individual corporate story and becomes a structural trend. By late 2024, Germany's industrial output had dropped to its weakest level since the pandemic-era disruptions. The early signs of hollowing out became harder to dismiss. And the energy policy choices added a dark layer of contradiction. In the middle of an energy crisis, Germany shut down its last nuclear power plants, stable, low-carbon baseload that could have anchored the system. To keep the lights on, it leaned more heavily on coal, even expanding lignite mining, one of the dirtiest forms of fossil fuel. The result was not just higher emissions, but higher costs and greater volatility, exactly the conditions heavy industry cannot tolerate. This is what deindustrialization looks like in a rich society. It doesn't arrive with a dramatic collapse. It arrives with quiet announcements, temporary shutdowns, delayed investments, and new factories built elsewhere. The signs appear first on the gates of plants that used to run 24/7. And once that base of physical production erodes, Europe loses more than jobs, it loses the ecosystem that supports innovation, training, exports, and strategic autonomy. If deindustrialization is Europe's heart problem, demography is the slow-growing cancer, quiet at first, then impossible to ignore. Italy is the clearest warning sign because it compresses the continent's future into a single country, stunning culture, world-famous lifestyle, and a population structure that is tilting toward collapse. In 2024, Italy's fertility rate fell to around 1.18 children per woman, far below the roughly 2.1 needed just to keep a population stable. Anything under 1.5 is widely treated as a demographic emergency, because it means the society is aging fast and shrinking over time. That doesn't just change the number of people. It changes the entire economic equation: fewer workers, fewer taxpayers, more retirees, and rising pressure on healthcare and pensions. Now picture a 25-year-old Italian graduate trying to start adult life. The macroeconomic story becomes painfully personal. Wages feel stuck, entry-level careers are harder to secure, and housing costs in the cities that actually offer opportunity can be punishing. Many young adults stay with their parents longer, not because of tradition, but because the math doesn't work. And then comes the real trap: the state expects that shrinking cohort of young workers to finance a growing cohort of retirees. Most European pension systems are pay-as-you-go. There isn't a giant vault where yesterday's contributions are saved for tomorrow. The payments retirees receive this month largely come from the wages of people working this month. In the 1960s, this was manageable because the worker-to-retiree ratio was favorable, multiple workers supporting each retiree. But as fertility falls and life expectancy rises, the ratio flips. In countries like Italy and Spain, the number of workers per retiree is heading toward 2-to-1 or worse. Run that arithmetic to its conclusion and the outcome is predictable: taxes rise. And they rise on the very group you need to keep, the productive young. When payroll taxes and income taxes climb, work feels less rewarding and the future feels like a bad deal. You're paying more to sustain a system that, by the time you reach retirement age, may be financially strained or politically unstable. So what do ambitious young people do? Many leave. They move to the United States, Switzerland, Australia, any place offering higher wages, lower tax pressure, or simply a stronger sense of upward mobility. That's how the demographic trap becomes a feedback loop. Young people exit, the tax base shrinks, the state increases pressure on those who remain. And even more young people decide the rational move is to go. In 2024, Italy recorded fewer than 370,000 births, the lowest number since national unification in the 1800s. The future arrives not as a headline, but as empty classrooms, understaffed hospitals, and a workforce that can't replace itself. Politics makes it harder. Older citizens vote at higher rates, and they understandably defend pensions and benefits they planned their lives around. Any leader who proposes significant pension cuts risks electoral disaster. Yet large-scale immigration, while economically helpful for labor supply, triggers cultural backlash and political instability. So the most common solution becomes delay, borrow more, patch the system, push the crisis forward another year. And that's the tragedy. This isn't about Italians being lazy or irresponsible. It's about incentives. When housing is expensive, wages are flat, and the future is heavily taxed, family formation becomes financially irrational. Demography isn't destiny, but when policy makes the choice to have children feel like a luxury, the numbers will eventually reshape the entire continent. Europe doesn't lack intelligence. It lacks conversion. The continent produces world-class scientists, engineers, and research institutions. The modern internet traces roots to work done at CERN in Switzerland. One of the world's most influential AI labs was founded in London. Talent isn't the bottleneck. The bottleneck is turning that talent into companies that scale fast enough to matter globally. A quick reality check makes the problem obvious. Try naming a European smartphone brand that still shapes the global consumer market. Nokia and Ericsson once dominated, but the center of gravity moved. Now try naming a European social network that became a true global platform. If your mind goes blank, that's not because Europe stopped producing smart people. It's because the modern economy is increasingly built on digital platforms, and Europe has struggled to build, scale, and retain them. The harsh pattern looks like this: the United States innovates, China copies and scales, and Europe regulates. Regulation isn't inherently bad. In many areas, privacy, safety, competition, rules can protect citizens and keep markets fair. The issue is timing, density, and fragmentation. Europe often tries to write the rulebook for an industry before it has built companies strong enough to compete within it. It's like drafting the laws for a Mars colony before you've finished the rocket. And unlike the US, Europe's market is not one market. It's a patchwork. In America, a startup can launch once and reach a continent, one main language, one broad legal framework, a unified capital market, and a shared consumer space of hundreds of millions. Growth can be exponential because the system is designed for replication. In Europe, expansion is an obstacle course. Each new country can mean a new language, different labor laws, different tax rules, different regulators, different compliance burdens, and different cultural expectations. Scaling becomes administrative rather than explosive, less like software and more like paperwork. That fragmentation changes investor behavior. Venture capital in Europe tends to be smaller and more cautious. Exits often arrive later, and IPOs are frequently smaller than their US equivalents. Risk-taking is less rewarded, failure is more stigmatized. And employee stock options are often taxed in ways that make them feel like salary instead of a long-term upside bet. The result is predictable: European startups don't necessarily die young. Many survive. But they stall. And stalled companies don't become global giants. When they finally become promising enough, they're often bought. Europe becomes a nursery where talent is trained and ideas are born, while the harvest happens elsewhere. You see it in headline acquisitions and in quieter patterns of ownership, research teams built in Europe, intellectual property consolidated in U.S. corporations, key products commercialized at scale from across the Atlantic. This creates a second feedback loop. Because Europe produces fewer tech giants, it captures less of the outsized returns that modern platforms generate. That means less reinvestment into the next generation of startups, fewer global-scale mentors and operators. And fewer deep-pocket acquirers who keep innovation ecosystems local. Meanwhile, Europe becomes more dependent on U.S. digital infrastructure, cloud services, app ecosystems, AI stacks, advertising platforms, the invisible rails that run the modern economy. Even when Europe attempts to respond, it often defaults to process. Comprehensive frameworks are debated, negotiated, and implemented across layers of institutions, while the technology cycles move at startup speed. The gap widens not because Europe chooses to do nothing, but because it chooses governance mechanisms built for stability in a world that now rewards velocity. So the innovation problem is not a lack of brains. It's a lack of scalable conditions, unified markets, deep risk capital, growth-friendly incentives. And a regulatory approach that protects citizens without turning expansion into death by 1,000 cuts. Until Europe solves that, it will keep producing brilliant people, and watching the biggest economic rewards of their brilliance accrue somewhere else. If you want to know what an economy really believes in, don't listen to speeches. Follow the money. Capital is brutally honest. It doesn't care about flags or nostalgia. It flows toward yield, liquidity, and confidence, and right now, a lot of that flow is moving out of Europe. The U.S. has a structural advantage that compounds over time. Its capital markets are deep, unified, and culturally central. A large share of American household wealth is tied to equities, which creates broad participation and a constant demand for investment opportunities. In Europe, households are far more likely to park savings in bank accounts with modest interest or in real estate. Fewer people own stocks, and that matters because it shapes the entire financing ecosystem. When households and institutions don't channel savings into equity markets, domestic companies have a harder time raising large amounts of growth capital without punitive terms. Now imagine you're building a biotech company in Berlin or a hardware startup in Munich. You need serious money, tens or hundreds of millions, to scale factories, hire specialized teams, and run long development cycles. In the U.S., you can often find large venture rounds, late-stage funding, and a path to a high-liquidity IPO. In Europe, the options can be narrower, banks want collateral, investors offer smaller checks. And the cost of capital can be higher because the ecosystem is less liquid and less growth-oriented. So founders and executives do what rational actors do, they look across the Atlantic. This is why even European success stories increasingly choose the U.S. financial system as their home base. Companies may be born in Europe, but they list where the capital is deepest, where valuations tend to be higher, and where analyst coverage and investor appetite are stronger. When a firm lists on Nasdaq instead of London, Frankfurt, or Paris, it's not just a symbolic loss, it's a pipeline shift. The gravitational pull of American markets becomes stronger, and Europe's becomes weaker. It turns into a self-reinforcing cycle. Investors in Europe see stronger returns in U.S. markets, so they allocate more capital there, directly or through funds. European companies, noticing the same reality, chase U.S. listings and U.S. investors. As more quality firms leave, Europe's markets look even less attractive, which pushes more savings abroad. Europe ends up exporting capital and importing growth. And the irony is painful, Europeans are among the world's best savers. The continent has enormous pools of wealth. But too much of that wealth is structured to protect against risk rather than finance expansion. So European savings help fund American innovation, American scale-ups, and American stock market performance. then Europe buys back the resulting products and platforms, paying rent to the very ecosystems its own money helped build. This is capital flight in its modern form. It's not suitcases of cash leaving in a crisis. It's spreadsheets, portfolio allocations, and listing decisions that quietly move the future elsewhere. And once that happens, the next generation of companies faces the same dilemma, with fewer domestic success stories, fewer deep local investors, and even more reasons to leave. Energy is the ultimate input. It's the currency of physics, the hidden cost inside everything you touch: steel, fertilizer, data centers, transport, heating, food prices, and the basic affordability of daily life. When energy is cheap and stable, an economy breathes easier. When it's expensive and volatile, everything becomes harder to plan, harder to build, and harder to compete. Over the past 2 decades, Europe positioned itself as a global leader in the green transition. In terms of intent, that's admirable. Climate change is real, and cutting emissions matters. The problem wasn't the goal. The problem was the sequence and the design. Europe tried to race to a cleaner system while weakening the very foundations that keep an advanced economy reliable: firm baseload power, domestic supply resilience, and predictable prices. The strategy had several pieces. Many countries, especially Germany and Belgium, moved to shut down nuclear plants that provided steady, low-carbon electricity. Europe also restricted or rejected widespread shale gas extraction through fracking, unlike the United States, which unlocked massive domestic supply and pushed prices down. At the same time, Europe invested heavily in wind and solar, which are clean but intermittent. And to fill the gaps when the sun didn't shine and the wind didn't blow, Europe leaned on cheap Russian gas as the backup plan. You can see the vulnerability instantly. The system assumed geopolitical stability. It assumed Russia would remain a dependable supplier. It assumed that global trade would stay frictionless. That world ended the moment the Russia-Ukraine war shattered the illusion. Suddenly, Europe had to replace pipeline gas with LNG shipped by sea, often at far higher prices, competing on a global market where supply is tight and bargaining power is uneven. At points, European energy prices spiked dramatically above U.S. levels, turning a foundational advantage into an ongoing handicap. For industry, that's devastating. In 2023 and 2024, European manufacturers faced electricity costs that were commonly several times higher than competitors in the U.S. and China. In a heavy industry like chemicals, metals, or advanced manufacturing, you can't innovate your way out of a power bill that's triple your rivals. Higher energy prices squeeze margins, kill investment, and push factories to relocate. That's not ideology. It's arithmetic. And the damage doesn't stop at factories. High energy costs hit households directly through heating and electricity bills. In countries like the UK and Germany, energy poverty stopped being an abstract phrase and became a measurable reality, families forced to choose between keeping warm and buying enough food. When energy becomes a luxury, social stability erodes, and political extremism gains oxygen. Then there's volatility, which may be even worse than high prices. A grid dominated by intermittent renewables without enough storage or flexible baseload becomes prone to wild swings. Prices can crash when supply is abundant, then spike when conditions change. That instability makes long-term planning difficult for businesses and discourages investment in energy-intensive growth. It also forces governments into constant emergency measures, subsidies, caps, market interventions, tools that can soften pain in the short term while adding distortion and debt in the long term. The darkest irony is that Europe's self-weakening doesn't automatically translate into meaningful global emissions reduction. Europe can shut down clean baseload at home, squeeze its own industry, and still watch global coal consumption rise elsewhere. A transition that destroys competitiveness before alternatives are fully ready doesn't create a greener economy, it risks creating no economy at all. This isn't an argument against climate action. It's an argument for realism. If the path to decarbonization makes energy permanently expensive and unreliable, Europe won't lead the future, it will finance someone else's. And in a world where energy is the backbone of both prosperity and security, that's not just a policy mistake. It's strategic self-harm. For 75 years, Europe enjoyed a historic bargain. The United States provided the hard security umbrella through NATO. And Europe used the breathing room to build generous welfare states, universal healthcare, long-paid vacations, and expansive pensions. It was the peace dividend, and it helped fund Europe's quality of life. But that dividend is ending. War returned to the continent, and Europe is being forced to rearm after decades of underinvestment. The problem is the timing. Defense spending has to rise just as growth is weak and populations are aging. Money for tanks is money not spent on hospitals, money for ammunition is money not spent on pensions. Europe is now facing a brutal equation, guns and butter at once, without the economic momentum or workforce growth that made the old model sustainable. At some point, a system doesn't collapse, it wakes up. For Europe, that moment arrived when it became impossible to pretend the old assumptions still held. The post-Cold War world that made Europe's model feel effortless is gone. Cheap energy is no longer guaranteed. Open trade is no longer a default setting. Security is no longer something you can outsource indefinitely. And the idea that prosperity will simply continue because it always has is the most dangerous myth of all. Europe is now realizing that stability without dynamism is not strength. It's a slow leak. That recognition has started to show up in the language of Europe's own institutions. The conversation has shifted from, how do we protect what we have, to something far more urgent, how do we remain competitive in a world where the U.S. and China are scaling technology, capital, and industrial capacity at a speed Europe can't match? The problem is no longer subtle. It's a competitiveness crisis, one that touches everything from supply chains to energy bills to the ability to build companies that matter. The proposed response, at least on paper, is massive. Europe needs investment on a scale that feels almost politically impossible, hundreds of billions per year, just to close the gap in innovation. Infrastructure, energy resilience, and defense readiness. Not a symbolic program. Not a press release. A real commitment big enough to change trajectory. And that, in turn, demands something Europe has historically struggled with: unity. Large-scale investment is easiest when a bloc acts like a single economy with shared priorities, shared financing tools, and a shared willingness to absorb short-term pain for long-term capacity. But Europe is still behaving like 27 countries wearing the same jacket. That's why the continent is standing at a crossroads. And the next decade will be defined less by grand speeches and more by what Europe actually chooses to do when trade-offs become unavoidable. Two futures are plausible. One is painful but hopeful. The other is comfortable, until it isn't. The first path is a renaissance. Not a miracle, not a slogan, but a deliberate redesign of incentives. It would start with simplification, fewer redundant rules, faster permitting, and a regulatory posture that protects people without suffocating scale. It would treat Europe as one real market, not a maze of mini-markets. A startup should be able to launch once and grow across the continent without redoing its entire legal and operational foundation every time it crosses a border. Next would come capital. Europe already has savings, it needs a better way to mobilize them. A unified capital market, deeper, more liquid, more growth-oriented, would keep European money funding European expansion. That means making it easier to raise large rounds, easier to reward employees with equity upside, and easier for companies to go public locally without being punished by low liquidity and low valuations. Then there's energy, the backbone of competitiveness. A Renaissance path would prioritize reliability and cost alongside decarbonization. That likely means rebuilding stable baseload capacity, including nuclear where politically feasible. while scaling renewables in a way that's matched by storage, grid upgrades, and realistic backup supply. The goal isn't to abandon climate action. It's to stop treating affordability and reliability as optional features. Finally, a renaissance requires fixing the demographic math. Europe cannot sustain generous welfare states with a shrinking workforce and a growing retiree population. Making family formation economically viable again would mean attacking the real constraints: housing affordability, childcare access, tax design, and career stability. You don't convince people to have children through speeches. You make the economics make sense. This path is possible. But it's hard. It requires coordinated reforms, political courage, and the willingness to tell voters that some comforts must be traded for long-term survival. It would be a controlled burn to save the forest. The second path is the museum. Europe remains rich, orderly, and beautiful, but increasingly defined by preservation rather than creation. Growth stays weak. Bureaucratic drag remains high. Major technology platforms remain foreign. Energy stays expensive and unpredictable. Young, ambitious workers quietly leave for places with more upside. And as domestic dynamism fades, ownership shifts outward: real estate, infrastructure, brands, and strategic assets purchased by global capital seeking stability and yield. In this future, Europe doesn't fall apart dramatically. It declines elegantly. Trains still run, just a bit slower. Hospitals still function, just more crowded. Taxes rise, just gradually. The skyline stays photogenic. The cities remain safe. Tourists keep coming. The continent becomes the world's most beautiful retirement home, wealthy enough to feel comfortable, not strong enough to shape the future. And the cruel twist is that doing nothing is still a choice. If Europe can't commit to the painful coordination a renaissance demands, then the museum path becomes the default, not because anyone voted for it, but because no one was willing to pay the price to avoid it. The unsettling thing about decline is that it rarely looks like a disaster while it's happening. It looks like normal life, just slightly worse every year. The lights don't go out. The currency doesn't vanish. The streets stay clean, the cafes stay open, the museums stay full. And that's why it's so easy to ignore. A society can lose its edge without losing its comfort. It can remain wealthy while slowly surrendering control over what comes next. That's the core lesson here, and it isn't just about Europe. Prosperity isn't permanent. It isn't a personality trait, and it isn't a birthright. It's an outcome, produced by systems that reward work, investment, innovation, and long-term planning. When those systems stop converting talent into productivity and savings into growth, the numbers eventually tell the truth. Economics doesn't run on nostalgia. It runs on incentives and arithmetic. Europe's story is a warning about what happens when a successful model becomes complacent, when politics favors delaying hard choices, and when institutions built for stability can't adapt to a world that suddenly demands speed and resilience. But if it can happen to a continent that shaped the modern world for centuries, it can happen anywhere. No country is immune to the slow drift of compounding decisions. No society gets a permanent exemption from trade-offs. And the most haunting part is how quietly it ends. There's no single moment when someone stands up and announces, "The golden era is over." Instead, it's 1,000 small signals: a factory that doesn't reopen, a startup that lists abroad, a young family that decides one child is too expensive, a pension promise that requires another tax hike, an energy bill that reshapes an entire industry's cost structure. People adapt. They adjust. They normalize the new baseline. Until one day, you look around and realize the party didn't end with a crash, it ended with people gradually leaving the room. If you want to understand the world that's coming, don't focus only on headlines or ideology. Watch the incentives. Watch the demographics. Watch the energy system. Watch where capital flows and where talent chooses to live. That's where the future is being written, quietly, relentlessly, in the language of numbers. If you want more breakdowns like this, where economics, technology, demographics, and geopolitics connect into one bigger picture, subscribe to Global Lens. Hit the like button if this made you rethink what decline actually looks like, and share it with someone who still believes prosperity is automatic. And tell me in the comments, if you were a 25-year-old in a stagnating economy with rising taxes and shrinking opportunity, would you stay and fight it out, or would you leave to build your future somewhere else? Turn on notifications so you don't miss the next episode. This is Global Lens, and we'll see you in the next one.